Hello, my name is Bob Kendall, Head of Retail Distribution for Deutsche Asset and Wealth Management in the Americas, and thank you for joining us for our first quarter update. I'm joined this afternoon by Dodd Kittsley, Head of ETF Strategy. Dodd, thanks for being here.
Thanks for having me.
Dodd, let's talk a little bit about China. China is really starting to see somewhat of an economic slowdown, obviously. What are Deutsche's thoughts on China overall? I mean, still obviously one of the largest opportunities out there, but good time to invest, bad time to invest? What are your thoughts?
We think it's a great time to invest for the long-term investor. Certainly there has been a slowdown, and our official forecast is for China GDP over the next 2 years to be about 6.8%. Now, it's hard to say that that's a bad number. It's envied by the rest of the world and among the highest in the rest of the world, but it's off of the levels that we've grown accustomed to. But when you dig a little deeper and take a look at the composition of that GDP growth, it's higher quality growth and much more balanced growth, where China is going through this wonderful transformation from an export-driven economy to one with far more balance and more domestic demand. And I think that's the real play here. It's the growing middle class in China and the maturation of China into really a global powerhouse.
Yeah, part of what comes with that is China is finally really opening up a lot more of its markets to international investors, international money coming in. We've seen the recent change being the Shanghai-Hong Kong Connect, which was launched last fall. How has this program really affected investments into China, whether that be in Hong Kong or in mainland China?
It's transformational, and I think it's a proof point that we're evolving dramatically within regulation and opening up China's capital markets. And as you mentioned, Shanghai-Hong Kong Connect has been a material evolution in that process. It's allowed investors without formal quota to come on a first-come, first-served basis to be able to access Chinese equities. We think it's a harbinger for things to come in terms of opening up other exchanges like Shenzhen, Hong Kong Connect, even the Chinese bond market. And as that happens, it's creating more and more of a catalyst for index providers such as MSCI to begin to include A-shares in their broader benchmarks, which would lead to material capital flows.
Interesting. Like all central banks, the PBOC has been hard at work as well. Talk to me a little bit about some of the reforms that we've seen and how that really affects the Chinese markets. And when you bring it back and think about our clients, our financial advisors, their investors, how can they benefit from these reforms?
The People's Bank of China and the Chinese regulators at large have really made the mainland China market relevant to U.S. investors, where previously it was very difficult. You had to access it through quota, through institutional funds. Because we've seen an evolution in terms of both RQF quota and then Shanghai-Hong Kong Connect, it's enabled vehicles like exchange-traded funds and like our ASHR and ASHS product to allow investors efficiently to be able to get broad-based exposure to this very exciting, very dynamic, and very different segment of market, of the Chinese market that they never had before.
Dodd, as always, great to see you. Thanks for sharing your thoughts with us on China today, and I'll look forward to seeing you at the end of the second quarter.
Thanks, Bob.
Carefully consider the fund's investment objectives, risk factors, and charges and expenses before investing. This and other important information can be found in the fund's prospectus, which may be obtained by calling 1-855-329-3837 or by viewing or downloading a prospectus. Read the prospectus carefully before investing.